Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway.
Hi, welcome to another edition of Master of the Markets. I'm Barry Habib of MBS Highway. This is created exclusively for Mortgage News Network. Hope you had a great week last week. It was an exciting one for the markets. We saw interest rates drop pretty significantly. And if you recall, it's exactly what we thought they were going to do. Remember our title from a couple of weeks ago, you're ready for the next leg down in mortgage rates. Well, we have started to see that in a big way. Now, could they go lower? We'll talk about that in a minute. There's a lot of news that's going to come up this week, which can certainly drive that. And there are other factors, the stock market, the oil markets. These are all intertwined and really having a big impact on the direction of interest rates for yourself, for your customers. And the way that we need to explain that is to understand what is happening. First, let's talk about some of the news from last week. It was a very quiet news week. Inflation data, very tame on the wholesale level. Now this week coming up, we're going to have more inflation data, more important report, Consumer Price Index, that measures inflation on a consumer level. And it is a more closely watched report, and it can certainly have more of an impact on the market. Thing of it is, remember, oil prices are dropping, prices at the pump dropping, and there isn't any inflation to speak of. So I really expect these numbers to be very tame. And it's supposed to be good when you have low inflation, but we've had so low inflation for such a long time that there are concerns of potential deflation. That's very bad for the economy. Also this week, we'll be hearing from the Fed. They have their Fed meeting, and that's a very important time for us to analyze what they say and hear if they're thinking about potentially raising rates sometime next year, removing language that says we're going to wait a considerable time, or if they're backing off of that and maybe concerned about the lack of inflation and leaving them in a position to where if they tighten, they could send the country into another recession or create some deflationary pressures. So the Fed's really walking a tightrope, and we'll have to listen. And we'll also get some housing data. And man, isn't it been such a good thing for housing for most of the country? We've seen nice, steady, and sustainable appreciation. Kind of Goldilocks, not too hot, not too cool. The media, of course, they've gotten it wrong, as they often do, and they love to strike fear in the hearts of consumers. So let's dissect that together and watch the news that comes out. Let's read deeper than just the headlines that the media gives us and understand what's going on, because I fully expect that housing to continue to move along at a slow, steady pace, but that's very healthy and, again, sustainable. All right, now I want to talk to you about the oil market. It's no secret that the biggest headline has been oil prices dropping. And we get all these talking heads on TV and people say, oh, isn't that great? All prices are low. And yes, of course, there's a lot of benefits. And people talking about it's great for consumers. It acts as a very large tax break in some extent. It's kind of similar to that. So all these things are true. Yes, there are a lot of positives to lower oil prices. But what they fail to recognize is there's a dark side to this. And that is why the stock market has really hit the skids. That's why stock prices have declined so much, and why we've seen a lot of that activity go into the mortgage bond market, where people are selling stocks, taking that money, buying bonds, buying treasuries, and causing interest rates to improve. So why in the world is bad oil prices something that the stock market's concerned about? How could it be negative for the economy? Well, once again, what they don't realize, the talking heads on TV and many of the analysts who really don't get it, don't understand how this works. You see, the oil and gas industry in the United States has been a real driver of economic growth and job creations. There are many parts in the country that are absolutely thriving, and we get those overall unemployment numbers, we get the overall job creations. So much is attributable to this industry. I'm not saying it's the only one out there that's contributing and creating jobs, but it is a big part. It plays a major factor. And if oil prices stay at these levels for a long time, below $60 a barrel, if they even go lower, well then it isn't profitable for a lot of these producers to stay online. And just like any business, you can lose money for a certain period of time. You can hang in there, hope it turns around. But if it sustains that way and doesn't turn around or continues to get worse, you have no choice but to shut down a profitable business. And then unlike many businesses which can shut down, a new one opens, or maybe they do something else, in this industry, you can't just flip a switch and turn it off and flip a switch and turn it on. Once they go offline, that's it. It's very hard for them to come back online. And that would very likely be difficult to see those jobs get recreated, at least in a timely manner. So it can have a negative impact on this fragile economic recovery that we're seeing. That's why the stock market has been declining, and that's why the stock market's concerned about this. Now let's look at the charts and see where the stock market could go. But remember, we got news items, and a lot's going to have to do with oil. If oil starts to rebound, so will stocks, and that's going to hurt interest rates in the bond market. All right, so we know the lay of the land. Let's see what the charts tell us. First off, I started with the stock market because this is what we've been talking about. Stock market hit exactly on that top that we identified. Isn't this interesting? And has since started to decline. Remember last week we were concerned about the stock market. Look at what it's done in the past week. Just a big, big drop. And this was the first floor, this 2018. This was an important level of test, and it broke beneath it on Friday in a big way. Once this floor was broken, the selling really accelerated. Okay, so now what's the next step? Well, the next step could be for us to see stock prices decline even further to this 1980 level on the S&P. So when we're talking about stock prices, we use the S&P 500. It is the most reliable indicator of the overall broad stock market. Now, stock prices did close at 2002 on the S&P, so this could be another 22-point decline. Really not that much when we see the movement in the S&P. This is going to be a critical test. This is an important floor, an important Fibonacci level. If we see a bounce here, then that will be good news for the stock market, but also not so good news for interest rates in the bond market. So this will have to be watched very carefully. This week is going to be extremely pivotal. We have to keep our eye on the ball and watch this 1980 level on the S&P. A break beneath there shows some real weakness in the stock market. We look at treasuries. Hey, look at this. 10-year treasury note, 2.08. Man, they thought we were crazy when it was near 3%. We said it's going to 2, and sure enough, it did hit this in October and closed like this 202 level. Reached this 202 level, and beneath it actually closed at 213 here. We've now had the best closing level, or lowest closing level, I should say, on the 10-year Treasury for the year. Could it go lower? It's possible. That's going to depend on the stock market. Rates are already terrific. Anybody who's taken out a mortgage in the last year and a half is a refinance candidate, and you need to be contacting them. But right now, we could see interest rates dip a little more if stock prices decline further, and interest rates should be able to reach this 202. This 202 level will correspond with 1980 on the S&P. All these numbers are tied together. We see 1980 on the S&P. You're going to see 202 on the 10-year Treasury. And if that happens, boy, it could be a quick fleeting opportunity. You need to take advantage of it and keep your eyes open. Because look, last time we had that big dip, and look what happened. Bounced right back up. We may get another bite at the apple here, another opportunity. Let's make sure that we take advantage of it and use that opportunity to lock in rigs. So now's the time. Prepare customers. Say, hey, this is a great time right now for you to consider refinance, consider your purchase, get ready to lock in. And if things change early in the week, and if we get that reversal, boom, lock them in and get these low rates. If we're able to see that ride lower, okay, we can ride a little bit lower. I think this may be a turnaround week. We have to be very, very careful. Turnaround for both stocks and interest rates. We'll see what happens. Hope you have a great day. And listen, you need to get this information every day. Don't be silly. Get a trial, get on board. And I think once you get the trial, I think you're going to get hooked, because this makes you a better advocate and a far greater resource to your referral partners. And why not do more business? There's so much on the site. Let us give you a walkthrough and show you all the tools. MBS Highway, best communication tool for you to beat your competition and get more transactions. Treat yourself this Christmas. Get on trial and get on board. Talk to you soon. Bye-bye.
Think you can use updates like this every day? Mortgage News Network viewers can get it free every day by visiting mbshighway.com/MNN. Master the Markets airs every Monday at 11 a.m. Eastern Time and can be viewed on mortgagenewsnetwork.com.
This is Mortgage News Network.